Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss if stimulus checks are the most effective way to stimulate the economy. But before we get into the stimulus checks, Phil, let's quickly check on the market because the Nasdaq 100 and the 10-year seem to be the correlation to watch.
Yeah, and what you can see over the last few weeks really is the market trying to work out whether we're going to get inflation, which might make rates go up, or not. So we've actually had markets kind of going sideways for a number of weeks now. A couple of weeks ago, we had a pretty positive week, but then last week, markets net fell, and it's all related to rates. So we keep talking about the 10-year, which is actually the rate that's gone up the most. And it's gone up from below 0.7% just before the election to over 1.7% in the middle of last week. Today, we're actually seeing markets sort of back on the growth trade. As you said, the Nasdaq's going better than the other two indexes, and that's because rates have sort of backed off a little bit. But it's all to do with what the markets are trying to do, forecasting the future of inflation.
And turning to the stimulus checks, a lot of economists have been saying the multiplier effect on the stimulus has been weak. What are people doing with their stimulus checks? Are they putting it into trading accounts or crypto accounts?
Well, maybe, but when you look at the data, it actually shows quite a lot of savings. So people are kind of getting the stimulus checks and either paying down debt or actually putting it in the bank for future bills. And that made sense, especially with the first one, because it was months until the next one. And you could see people's net savings spiked on the stimulus checks, and then slowly over time that whittled away. And what that means is, to your point about the multiplier effect, you put $600 in someone's pocket, they don't go out and buy $600 worth of clothing and food, which gives $600 back to the restaurant worker and the clothing store, which they can then hire more people with who earn more money and go and spend it themselves. And that's the multiplier effect. If we save all the money, then nothing extra gets spent, and it actually doesn't boost the economy as much as it could otherwise.
And Phil, do you think it could be they're not able to spend on hospitality and leisure as much as they would like to?
Yeah, and that's another one of the theories. You look at the data, leisure and hospitality in particular, but lots of other areas of the economy are still below pre-COVID levels. A lot of the services sector are still not fully recovered. And so you look at the leisure and hospitality, that's 20% below pre-COVID levels. But then you look at some of the sort of more extreme industry groups like airlines, and they're only just got back above 50% down on pre-COVID levels. And that's with a pretty solid spike in traffic and travelers since the vaccine started to roll out. So there's a few industries where there's probably a lot of people still waiting to come back to work and a lot less income than they used to see. And that's a lot of services sectors. So if we get the vaccines out into the society, there's a lot of pent up savings, and there's a lot of services that we used to consume that potentially people will rush back into.
And moving to inflation, that really has been the story and what we've been discussing for weeks now. The market and the Fed seem to have diverging opinions on a spike in inflation.
Yeah, I think, I guess the general consensus is that we'll see a short-term spike in inflation. A lot of people put the spike as high as 4% when the services demand returns, if there's a little bit of a bottleneck getting people back into restaurants as servers, getting hotels spooled back up, fitting everybody back on the planes, getting the planes back into service. Oil prices are rising. We know that already. So a lot of the services space could see inflation just from a demand push. We're already seeing inflation on the manufacturing and production side. But I think there's also a school of thought that says it'll be short term. We'll learn to digest it. There's 10 million people who are still unemployed. And when they get back to work, we'll have plenty of supply. And so it'll kind of keep a cap on just how much and how long the inflation lasts.
And Phil, let's wrap with COVID-19 data. So much continues to hinge on the success of vaccination rollout and the willingness to get that jab.
Yeah, so if you look at, Israel is the sort of case study everybody's looking at because it's had a really strong rollout. It's got a lot of the population, the majority of the population vaccinated already. But the exponential growth curve that we're seeing, they're starting to see slow. Even the UK, it's sort of forecast that the rate of injections in the UK, which is ahead of the US, will start to slow a bit too. So it'll be interesting to see once we get to sort of that 50-60% level, whether the anti-vaxxers and people that just don't want to get a vaccine kind of turn around and get one, or whether we do really struggle to get to that sort of 70 to 80% level that we think we need for herd immunity. But looking at the forecast, the US is actually doing pretty well at getting its vaccines rolled out. And the forecast is that by summer, we will, if everybody keeps going at this rate, have pretty much everybody vaccinated. Europe's a bit slower. And then obviously the rest of the world, it's going to be years until we potentially are, able to see Africa and some of the less wealthy countries fully vaccinated.
All right, Phil, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.